Rohr here with an early global view on Tuesday, July 15th, 2014. And it's approximately 5:45 a.m. U.S. Central Time, and it's going to be a global view today, in part because we want to follow up on all the markets after taking a break yesterday during what was a very quiet reporting day. How does all of this week data play out in the equities? Well, due to the interpretation, more so than any striking figures, the interpretation of some earnings we saw on Monday, the equities were rather enthused, and some of the geopolitical stresses have calmed down as well. So we got this very nice gap higher, all the way up from the low 1960s in the September S&P 500 future hourly chart here on the left, 30-minute, of course, on the right as usual. And yet, as we noted in our brief note yesterday, these things are all still within ranging sort of activity that we had highlighted in last Thursday's general update, global view on all of the markets, and revisited in the equities on Friday. So only getting back up to the bottom of the gap lower from the beginning of last week, near the bottom of the gap lower, up near the 1975 area yesterday. Again, it looked kind of impressive on the gap higher early. We also had the escape of the upper runaway band on the hourly MACD, but unless the market was going to overrun this 75 to 77.5 area, it wasn't really proving anything. It's still a ranging market, and lo and behold, today it's off about $3, back down around the 1968 levels. So starting to act like a ranging market once again. We also felt that yesterday might have in part been anticipating what Janet Yellen had to say. She had foreshadowed it in a magazine article that she's still sticking with her view that rates will be kept low even once the economy starts to show improvement. In other words, still very accommodative. So the question is, if people bought the rumor and the anticipation on Monday, what happens on the fact today once she gets into her testimony and especially the Q&A? Lower support would be initially back at the up break out of the overall downward channel from the high from a week ago Thursday. Of course, that was the holiday shortened week, so this was the end of the week here on July 3rd. This was the weekly close up at 1977.60. So this overall downward channel was broken up right around the 1960 area, and that plays in pretty well with previous important supports that get down into the mid-1950s once again. If the market should escape to the upside, of course, be keeping an eye on the 1978 all-time lead contract futures high set back on July 3rd. But the extended resistances now, due to the rising weekly chart channel, would be, even at that, only right up around 1980 or so initially. So even if the market should put in a minor new high, it's going to have to get out through 1980 to 85 to really say it's escaped for that move some people are expecting up toward the 2000 area. That pretty much does it for the short-term view of the S&P. On the intermediate term picture, what we see is that top of the channel right up there into the right up there in the 1980-81 area, and we note that with the 41-week average up around 1845, would actually be a bit better than that if the market should push up there. If we add the 130 to 135 points over on the oscillator, that would be the next key resistance. The market would also point towards something around 1975 to, at the high end, 1980 as the area from which the market would have to escape. So the oscillator and the topping line are very well correlated at this point, which is not always the case. And you can see on the daily chart that same gap from the gap lower coming in last week, Monday, from the holiday weekend in the U.S. So 1975 to 77.5 will be the resistance above the market.